Liz, if you see a headline like that, like Trump and Xi are expected to speak soon, but not necessarily today. We got the retaliatory tariffs overnight. What do you think as an investor?
This is not over. I think, first of all, obviously we're seeing today a reaction in the market, a sector reaction in the market that's almost in direct response to everything that's happened over the last 36 hours. But I don't think this is over. And frankly, with China, I think it's far from over. So there's a lot more news that's likely yet to come.
Does that make you more cautious on the market overall?
It makes me cautious in the sense of you don't want to reprice everything right now and assume that we've figured it out and assume that we've heard all that we're going to hear. I think China will retaliate much more strongly than some other nations. And I think this game will continue for a while. And remember, this story with China is years old now. This is not something that we've established as, we've sort of solved the problem. So I think there's still a lot more to come. The sectors that are the most sensitive to Chinese tariffs and this part of the trade war, so to speak, are going to be consumer discretionary and technology. And we're going to continue to have this whiplash of risk on, risk off in the market. So investors have to stay wary of that.
Aya, have you changed any of your exposures or allocations given what we've seen with tariffs?
No, Sarah, we have not changed anything, at least. I think we're still in the phase where we're digesting exactly how this is all going to play out. Is it a negotiating tactic? Are they going to, actually put these tariffs into place? How bad would a trade war become with all of the retaliatory policies that might get put in place? And so, we're taking a longer term view on many of these things and trying to understand what the true implications will be, not just today, but, in the next 12 months.
I mean, one thing you both are saying is that the risk is not going away. It's going to be with us. So how do you... Does it shake your conviction, for instance, if we have more days like yesterday, where he actually did pull the trigger until we got the phone calls?
It doesn't shake my conviction in the longer term stories. I think that this rotation that's been happening under the surface in equities will continue as long as the economic data in the U.S. stays strong. And that's still been the story here. So as long as the labor market stays intact, I know we got some shaky JOLTS data today, but as long as the labor market stays intact.
Still elevated openings, even.
Still elevated, but below expectations, let's call it. And as long as inflation doesn't re-spike, then I think we're still okay. And if growth continues to stay solid, then you've still got this story behind the market that everything is okay. You might see investors rotate out of things that are highly valued and into other things. So I still believe healthcare is a good place to be. I still believe CapEx dollars will flow to software rather than semis this year, or at least comparatively speaking. I think materials can catch a bid here. I think financials stay solid. So I think that this rotation story under the surface stays intact.
You didn't mention energy. Is there a reason?
Well, energy is really sensitive to these geopolitical risks. So today we're seeing energy as the top performing sector, but I think that's directly in response to the Canada and Mexico tariffs, particularly Canada tariffs being paused for a month. So you don't want to react on a one-day move and buy something like energy. I like to think of it as don't make permanent decisions based on temporary emotions. We're going to get these daily headlines. You don't want to change your investment allocation just based on that. And energy is something that I am positive on for the year, but mostly for an M&A activity standpoint, not because we think that tariffs are going to affect the energy story.